Hey everyone, Longacres Finance here, and it's time for the June 2021 High Yield Dividend Stock Watchlist. The watchlist for this month includes only 19 stocks, which is down from the 22 stocks we had last month. As high-yielding dividend stocks continue to see strong market performance, the monthly list I track keeps getting shorter. A stock must have at least a 2.75% dividend yield to make the watchlist, as well as pass a few other quality metrics. The 22 stocks for May 2021 had a return of 2.47% last month. The 16 fairly valued and undervalued stocks from May had a return of 1.83% last month. Both came up shy of VYM, Vanguard's high-yield dividend ETF, which was up 3.03%. But they did beat SPY, the S&P 500 ETF, that returned only 0.66%. It's really hard to outperform an index fund picking stocks on your own. While the watchlist I track has only managed to do so for 3 of the last 7 months, it is outperforming in terms of total return. If you like selecting your own stocks and are looking for high-yield dividend stock ideas, then you need to check out this month's list of stocks. If you're new here, consider subscribing for more dividend investing videos and to make sure you don't miss future updates to the watchlist I track. Alright, let's take a look at the watchlist for June, and then I'll circle back to review past performance in detail. 4 stocks from the May watchlist have dropped off this month. They are Bank of Montreal, Rogers Communications, Royal Bank of Canada, and Toronto Dominion Bank. And only one new stock has been added, CMS Energy, that returns to the watchlist after sitting out the month of May. Here are all 19 high-yield dividend stocks for June 2021. The average dividend yield for all 19 is 3.3%. The average 5-year dividend growth rate is 11.57%. And collectively, these stocks have a payout ratio of about 64%. That is a pretty attractive dividend yield with a strong history of growth and room for future dividend increases. Based on dividend yield theory, only Southern Company appears to be more than 5% overvalued right now. They are 9.03% overvalued to be exact. Let's break this list down by sector. The highest number of stocks on this list are utilities. We have a total of 7 stocks, and they are CMS Energy, DTE Energy, Evergy, Alliant Energy, Southern Company, Sempra Energy, and WEC Energy. DTE Energy, Evergy, and Sempra Energy appear to be undervalued right now based on dividend yield theory. CMS Energy appears to be about fairly valued. Alliant and WEC are overvalued but within the 5% threshold, and Southern Company is about 9% overvalued. Southern also offers the best dividend yield right now of 4.13%. CMS offers the lowest dividend yield of 2.77%, which is just above the cutoff, so don't be surprised to see the stock drop off the list once more if the share price climbs this month. Sempra Energy and Evergy have the strongest dividend growth histories, both with double-digit 5-year growth rates. All 7 stocks have very reasonable payout ratios in the 50 to 60% range, with the exception of Southern that is closer to 80%. The next sector up is consumer staples, and we have a total of 4 stocks here. They are Kellogg, Kimberly-Clark, Pepsi, and Philip Morris. Philip Morris has the most attractive current dividend yield of 4.98%. Pepsi has the best 5-year dividend growth rate of 7.8%. Kellogg and Kimberly-Clark have the more attractive payout ratios in the 50 to 60% range. Pepsi's payout ratio is still reasonable, around 75%, and Philip Morris is sitting around 86%, but they have historically always had a high payout ratio. Kellogg, Kimberly-Clark, and Pepsi appear to be undervalued right now, and Philip Morris is closing in on the 5% overvalue threshold. Up next, we have 3 financial stocks. They are Comerica, Principal Financial Group, and Truist Financial. Principal Financial Group sports the highest current dividend yield of 3.73%. Comerica has the highest 5-year dividend growth rate of 27.1%, and all 3 of these stocks have very attractive payout ratios in the 30 to 50% range. Comerica appears to be the most undervalued right now. Principal looks to be fairly valued, and Truist is about 4.5% overvalued. Up next, we have 2 healthcare stocks. They are Amgen and Merck. Merck offers the better current dividend yield right now of 3.43%, but Amgen has a stronger dividend growth rate of 15.16% and a more attractive payout ratio around 55%. Both appear to be undervalued right now by about 11%. Up next, we have 2 information technology stocks. They are Broadcom and Cisco. Broadcom offers the better current dividend yield of 3.05%. They also have a very strong dividend growth rate, averaging 53% growth over the last 5 years. Cisco has a slightly lower dividend yield, a reasonable dividend growth rate of 12.5%, but it does have a better payout ratio below 50%. Broadcom appears to be undervalued based on dividend yield theory, while Cisco appears to be about 4% overvalued. And the last stock on the June list is 3M Company, the lone industrial stock. 3M has a dividend yield of 2.92%, with a 7.48% dividend growth rate, and a sub 60% payout ratio. Based on dividend yield theory, they appear to be about 4.5% undervalued right now. Let's jump over to historical performance and see how the stocks from the prior watchlist have performed. Like I stated in the beginning of the video, the watchlist returned 2.47% in May. The fairly valued and undervalued stocks for the month performed worse with a return of 1.83%. VYM returned a cool 3.03%, and SPY was up only 0.66%. Year to date, thus far, the entire watchlist has the best return of 18.76%. The fairly valued and undervalued stocks are just ahead of VYM with a return of 17.51%. VYM has a return of 17.48%, and SPY trails with a return of 12.72%. Since inception, or November of 2020, the entire watchlist is also in first place with a return of 38.28%. The fairly valued and undervalued stocks are in second place with a return of 37.62%. VYM is in third place with a return of 36.38%. And SPY is in fourth place with a return of 29.62%. Normally, a high dividend yield investing approach will not outperform SPY. I think we just happen to be in a period of strong performance for high yield dividend stocks. In the long term, I expect SPY to bridge the gap and outpace the watchlist and VYM. Perhaps the fairly valued and undervalued approach will also outpace both the watchlist and VYM in the long term. Undervalued stocks take time to yield better returns, and the 7 months of history I have here is not really that long of a time period. But the purpose of a high dividend yield investing approach is not to outperform the market, but to offer a solid stream of passive cash flow. And that is what high dividend yield investors seek. The stocks on this watchlist should offer strong, safe and growing dividend income in the future. Another approach I track here is a buy and hold approach. The premise is simple. If you bought and held stocks from the watchlist each month, adding more capital each month to the stocks on each month's watchlist, what type of results would that have achieved thus far? The results for May were as follows. The entire watchlist would have returned 3.03%, beating the watchlist return for May. The buy and hold approach to the fairly valued and undervalued stocks would have returned 2.27% in May, also beating the return of the fairly valued and undervalued stocks for May. On a year-to-date basis, the entire watchlist is up 21.11%, and the fairly valued and undervalued stocks are up 20.56%. Both buy and hold portfolios are achieving better returns than the individual monthly watchlists. This simply means that when a stock falls off the watchlist, that does not indicate the stock should be sold. Oftentimes, a stock will fall off the watchlist because its dividend yield dips below the threshold, or it fails to meet one of the quality metrics. But the stock may continue to see positive returns going forward. Since inception, the fairly valued and undervalued buy and hold approach is actually performing the best, with a 41.41% total return. The entire watchlist buy and hold approach is up 40.99%, and VYM is up only 36.38%. Let's take a look at some individual returns for May. Some of the best returns in May came from financial stocks. Bank of Montreal was up 11.32%. Canadian Imperial Bank, which hasn't been on the watchlist since 2020, was up 13.38%. The buy and hold approach still benefits from this strong return, which is one of the drivers of the outperformance. Another strong financial stock in May was the Royal Bank of Canada, which was up 9%. Actually, all of the Canadian banks had a pretty solid month. In addition to the financial stocks, CVS Health was up 13.14% last month. The stock dropped off the watchlist in April 2021, but has continued to provide positive returns since. The best return since joining the watchlist comes from Bank of Montreal, that is up 80.21% over the past 7 months. Another strong performer has been Principal Financial Group, that is up 70.25%, also over the past 7 months. Toronto Dominion Bank is up 66.32% since joining, and Truist Financial is up 50.47% since joining. Several of the current stocks on the watchlist have not been on the watchlist for all 7 months, therefore they may not have such strong returns yet. The poorest result thus far is Kimberly-Clark, which is down 0.24% during its 4-month history on the watchlist. But that's the way investing works. Sometimes the stocks you pick end up winners, and sometimes they don't. It's highly improbable to pick only winners. But the key is, if you stay consistent and spread the risk around by investing in multiple stocks, you will catch some of the winners that will offer strong returns, that will outweigh the losers and drive the performance of your portfolio. That's it. Thank you for watching and see you next time.